Before we begin, please be aware that I am not a financial advisor. The content in this presentation is for informational and educational purposes only. It should not be construed as financial, investment, legal, or tax advice. The cryptocurrency market is extremely volatile, and you should always conduct your own research and consult with a qualified professional before making any investment decisions. Investing in cryptocurrencies carries a significant risk of loss, and you could lose your entire investment. Past performance is not indicative of future results. You're staring at your phone again. That little green and red chart that dictates your mood for the day. It's been flat. Or worse, it's been bleeding out. You bought in during the hype, convinced this was your ticket. You listened to the gurus on Twitter. You watched the videos promising a Lamborghini by Tuesday. And now you're just confused. One day, you hear Bitcoin is going to $1 million. The next, you hear it's a scam going to zero. You're trapped in a whirlwind of noise, and the only thing you know for sure is that your portfolio isn't doing what they promised it would. That feeling of confusion, of doubt, of wondering if you missed the boat or even worse, boarded the Titanic, that is the single biggest barrier to building real life-changing wealth in the crypto space. And in this video, we are going to end that confusion for good. We are going to cut through every single piece of noise, every guru's opinion, every headline, and get to the absolute core of what matters. We're going to dissect what the real experts, the Wall Street analysts, the billion-dollar fund managers, the institutional players who are actually moving the market, are saying about the future of crypto prices. This isn't about my opinion. It's about theirs. By the end of this, you won't just have a vague idea of where the price might go. You will have a crystal-clear framework for understanding the forces at play, allowing you to make your own informed decisions with confidence, not fear. We are standing at perhaps the most important crossroads in financial history. We have the recent approval of Bitcoin ETFs by the largest asset managers on planet Earth, like BlackRock and Fidelity. We have the Bitcoin halving, a pre-programmed supply shock that has historically kicked off every major bull run. And we have a global economic environment that is forcing people to look for alternatives to traditional money. These forces are converging right now, and the next 12 to 18 months will likely determine the financial future for an entire generation of investors. Getting it right now is everything. So, how do we make sense of it all? After analyzing hundreds of reports, interviews, and forecasts, I found that virtually every expert opinion falls into one of three distinct camps. First, you have the hyperbulls, the ones who believe we are on the verge of an explosive, face-melting rally that will dwarf anything we've ever seen before. Second, you have the cautious optimists. These are the pragmatists, the ones who see incredible potential but are also keenly aware of the massive hurdles that still stand in the way. And third, you have the doomsayers, the experts who believe this entire house of cards is about to come crashing down. To truly understand the future, we have to understand all three. And we're going to start with the most explosive one, the hyperbulls. The argument from this camp isn't just wishful thinking. It's based on a fundamental shift in the very structure of the financial world. And it all starts with two letters, EF, the spot Bitcoin exchange-traded fund. For years, this was the holy grail for the crypto industry. And for years, the SEC, America's top financial regulator, said no, over and over again. But in early 2024, everything changed. They gave the green light. Now, why is this such a monumental deal? Think of it like this. Before the ETFs, buying Bitcoin for a major institution, a pension fund, or even just your average retirement advisor was a nightmare. It involved setting up specialized accounts, dealing with crypto exchanges, worrying about custody, security, hacks. It was like trying to buy a stock in the 1980s by physically mailing a check and waiting for a paper certificate. It was slow, risky, and complicated. The ETFs changed all of that overnight. Now, buying Bitcoin is as easy as buying a share of Apple or Tesla. Any financial advisor, any retirement fund, any hedge fund in the United States can now get exposure to Bitcoin with a simple click of a button, right from the same brokerage account they've used for decades. The floodgates haven't just been opened, they've been blown off their hinges. And the entity that lit the fuse was BlackRock, the largest asset manager in the world, with over $9 trillion under management. This isn't some Silicon Valley startup. This is the beating heart of the traditional financial system. When BlackRock CEO Larry Fink, who once dismissed Bitcoin, goes on national television and calls it an international asset and digital gold, the entire world of money sits up and listens. The hyperbulls argue that we have not even begun to feel the effects of this. The initial inflows into the ETFs were just the first tiny trickle. That was the easy money, the early adopters. The real money, the institutional capital, moves like an aircraft carrier, not a speedboat. It takes months, even years of due diligence, committee meetings, and risk assessments before a major pension fund allocates even 1% of its portfolio to a new asset class. The hyperbulls believe that over the next 18 months, we're going to see a steady, relentless wave of capital flowing from the traditional financial world into this very small, very illiquid asset. We're talking about trillions of dollars that can now access Bitcoin for the first time. And when that kind of money enters an asset with a fixed supply of only 21 million coins, the law of supply and demand becomes incredibly powerful. Which brings us to the second pillar of the hyperbull case, the Bitcoin halving. This is a beautiful piece of code at the heart of Bitcoin. Every 4 years, the reward that miners get for creating new Bitcoins is cut in half. This is a pre-scheduled, perfectly predictable supply shock. The creation of new Bitcoin slows down permanently. Every single time this has happened in the past, in 2012, 2016, and 2020, it has been followed by a massive parabolic bull run. Now, past performance is no guarantee of future results, but the pattern is undeniable. And this time it's different. For the first time in history, we have a major supply shock, the halving, colliding with a potential demand explosion from the ETFs. Less new supply is being created at the exact same moment that potentially millions of new buyers are gaining access. From a purely economic standpoint, it is a recipe for a violent upward repricing. So what kind of numbers are these hyperbulls talking about? This is where it gets really wild. Cathie Wood, the CEO of ARK Invest, is one of the most prominent voices in this camp. Her firm has put out a price target for Bitcoin of $1.5 million per coin by the year 2030. Now that sounds insane, but their logic is based on a simple premise: asset allocation. They calculate that if institutional investors were to allocate just a small fraction, say 2 to 5%, of their massive portfolios to Bitcoin, just as they do with other alternative assets like real estate or gold, the math leads you to a price well over $1 million. It's not based on hype. It's based on Bitcoin capturing a tiny slice of the global wealth pie. Another prominent bull, Michael Saylor, the founder of MicroStrategy, calls Bitcoin the apex property of the human race. He sees it not just as an investment, but as the ultimate solution to the problem of inflation and currency debasement. He argues that as governments around the world continue to print money and devalue their currencies, capital will inevitably flee from weaker assets into the strongest one: a decentralized, provably scarce, digital asset. For him, Bitcoin isn't competing with other cryptocurrencies. It's competing with gold, with the S&P 500, with real estate. It's competing to become the world's primary store of value. And if it captures even a fraction of the value stored in those other asset classes, which are measured in the hundreds of trillions of dollars, then a price of $1, $2, or even $5 million per coin isn't just possible. He believes it's inevitable. The hyperbull case is intoxicating. It paints a picture of a perfect storm where institutional adoption, a programmed supply shock, and a shaky global economy converge to launch Bitcoin and the entire crypto market into a new stratosphere. It's a vision where buying even a small amount of crypto today could be the single most important financial decision of your life. It's the story of a technological revolution that's only just getting started. But what if they're wrong? What if this is all just a grand illusion? A narrative built on hope and speculation? What if the trillions of dollars of institutional money never actually show up in force? What are the massive risks they are conveniently ignoring? The cautious optimists see the same landscape, but they draw a very, very different map. They believe the path forward is not a straight line up, but a minefield of regulatory crackdowns, technological hurdles, and human psychology. And understanding their perspective is absolutely critical before you invest another dollar. Let's start with the regulator. Imagine a man in a gray suit, sitting in a Washington, D.C. office, whose entire job is to protect the American public from financial ruin. His name is Gary Gensler, the head of the SEC, and to him, the crypto landscape isn't a brave new world of decentralized finance. It's the Wild West, filled with unregistered securities, market manipulation, and scams. His perspective, and the perspective of regulators worldwide, is the single biggest storm cloud on the crypto horizon. The core of their argument is deceptively simple. Most cryptocurrencies, they argue, aren't currencies or commodities. They're securities. They're investment contracts. When you buy a token, you're often investing in a common enterprise with the expectation of profit based on the efforts of a core team of developers. Sound familiar? It should. That's the Howey test, a legal standard that's been around since 1946. And if these tokens are securities, they must play by the same rules as stocks. They need to be registered. They need to provide disclosures. They need to protect investors. But almost none of them do. This creates a massive existential threat. The SEC isn't just targeting small, obscure projects anymore. They've gone after giants like Ripple and Coinbase. Every time a new enforcement action is announced, it sends a shockwave through the market, not just because of the specific project involved, but because of the precedent it sets. It's a sword of Damocles hanging over the entire industry. This regulatory uncertainty freezes institutional money on the sidelines. Why would a major pension fund or insurance company invest billions into an asset class that could be declared illegal or be crippled by new rules overnight? They won't. This regulatory choke point is the first, and perhaps most powerful argument from the skeptics. They believe that governments will never willingly give up control of the money supply, and they will use the full force of their regulatory power to tame, tax, and control crypto until it no longer resembles the disruptive force its proponents claim it to be. But let's say for a moment that the regulators back off. Let's say they create a clear, friendly framework for crypto to operate in. The skeptics would argue that you still have an even bigger problem. The assets themselves are fundamentally worthless. This is the intrinsic value argument, most famously championed by figures like Warren Buffett. Think about it this way. When you buy a share of Apple stock, you own a tiny piece of a real company. A company that makes iPhones and MacBooks, that generates hundreds of billions of dollars in profit, that employs real people and owns real assets. That profit gives the stock a fundamental value, a floor. When you buy a piece of real estate, you own a physical asset. You can live in it, rent it out for income, or grow crops on the land. It has tangible utility. Now, what do you own when you buy most cryptocurrencies? You own a string of code on a distributed ledger. It doesn't generate revenue. It doesn't pay a dividend. It doesn't represent ownership of anything tangible. Its price is based on one thing and one thing only: the belief that someone else will be willing to pay more for it in the future. This is what economists call the greater fool theory. You might not be a fool for buying it at $10,000, as long as you can find a greater fool to buy it from you at $20,000. But eventually, the skeptics argue, you run out of fools. When the music stops, when the hype dies down, what are you left with? An entry in a database. This is why Buffett has called it rat poison squared. It's not just that it's a non-productive asset. It's that it attracts a wave of speculative frenzy that has no connection to any underlying economic reality. The price swings aren't based on earnings reports or product launches. They're based on tweets, memes, and pure unadulterated FOMO, fear of missing out. For these experts, it's not an investment. It's a gamble, a digital tulip mania for the 21st century, and they believe that, like all bubbles built on pure speculation, it is destined to pop. But even if you can get past the regulatory threat and the intrinsic value debate, the bears point to a third critical failure point: the technology itself. For all the talk of crypto revolutionizing finance, they ask a simple question: what can you actually do with it? Right now, for the average person, the answer is not much. The dream was a new financial system, faster, cheaper, and more accessible than the old one. The reality has been a frustrating mess of complexity, high fees, and slow transaction times. Trying to buy a cup of coffee with Bitcoin is practically impossible. The transaction could take 10 minutes to confirm and cost more in fees than the coffee itself. Ethereum, the backbone of DeFi and NFTs, has been plagued by crippling gas fees. During periods of high demand, a single transaction could cost $50, $100, or even hundreds of dollars. It's like having a superhighway where the toll costs more than the car. This is the famous blockchain trilemma. You can have decentralization, security, and scalability, but you can only pick two. Bitcoin and Ethereum chose decentralization and security, sacrificing scalability. Newer blockchains claim to have solved this, but they often do so by sacrificing decentralization, running on a small number of powerful servers that look suspiciously like the centralized systems they were meant to replace. The user experience is another massive hurdle. Setting up a crypto wallet, securing your private keys, and interacting with decentralized applications is a technical nightmare for the average person. It's like having to be your own mechanic just to drive a car. Compare that to the seamless experience of using Apple Pay or swiping a credit card. The skeptics argue that until crypto is as easy to use as the internet, it will remain a niche hobby for tech enthusiasts and speculators, not a tool for the masses. It's a brilliant solution in search of a problem that it can actually solve better, cheaper, and faster than the existing solutions. And so far, in the real world, outside of speculation, they argue that use case simply hasn't emerged. So we have a three-headed monster standing in the way of crypto's future. A regulatory guillotine, ready to drop at any moment. An economic foundation built not on value, but on the hope of finding a greater fool. And a technology that, for all its promise, remains too slow, too expensive, and too complicated for mainstream adoption. When you lay it all out, the case against crypto seems overwhelming, almost airtight. It's a powerful narrative that suggests the whole thing is a house of cards, built on a foundation of sand, just waiting for the tide to come in. It seems like the game is already over. But this is where the story takes a sharp, unexpected turn. Because the proponents, the true believers, have an answer for every single one of these points. They believe the skeptics aren't just wrong. They're looking at the world through an old lens, failing to see a fundamental paradigm shift that's happening right under their noses. And their counter-argument is not just about technology, it's about the very nature of money itself. This new school of thought, the one the skeptics are missing, starts with a question so simple it sounds almost childish. What is money? Seriously, think about it. We use it every single day, we work for it, we worry about it, but what is it? For most of human history, money had to be something tangible. A seashell, a bushel of wheat, a gold coin. It was an object that had value in and of itself, or at least was universally agreed upon to represent value. Gold was the ultimate winner of this contest for centuries. Why? Because it was scarce, it was durable, you couldn't just create more of it out of thin air, and it was divisible. It had the properties of good money. Then something changed. We moved off the gold standard. Money ceased to be a tangible asset and became a promise. A promise from a government. The dollar in your pocket is not backed by a vault of gold in Fort Knox anymore. It's backed by the full faith and credit of the United States government. This is what we call fiat currency. Fiat from the Latin, meaning let it be done. Money exists because the government says it exists. And for a while that system worked, or at least it seemed to. But the proponents of this new digital age argue that the cracks in that system have turned into gaping canyons. And the central argument, the one that underpins the most bullish crypto predictions, is this: the promise has been broken. The very nature of fiat currency, controlled by central banks, gives them a superpower no one in history has ever wielded so effectively: the ability to print infinite amounts of it. When an economy falters, what do? Print more money. When a pandemic hits, print trillions more. Each new dollar printed devalues every other dollar already in existence. It's a slow, silent tax on your savings called inflation. It's the reason your grandparents could buy a house and support a family on one salary, while today many struggle to even afford rent. The purchasing power of the dollar isn't just falling. It's in a nosedive. This is the paradigm shift. It's a realization that the base layer of our entire global financial system is built on a melting ice cube. And this is where the experts who see a different future enter the picture. They aren't just tech nerds excited about a new gadget. They are macro investors, CEOs, and financial philosophers who looked at this melting ice cube and started searching for a lifeboat. One of the most prominent and vocal of these figures is Michael Saylor, the CEO of MicroStrategy. Saylor isn't some fly-by-night crypto promoter. He's a brilliant MIT-trained engineer who built a multi-billion-dollar software company. For years, his company sat on a massive pile of cash, $500 million in its treasury. And he watched in horror as that cash, his company's hard-earned value, was losing 10 to 15% of its purchasing power every single year due to inflation. He called it a melting ice cube. He realized that holding cash was like storing your wealth in a container with a hole in the bottom. So he went on a quest. He studied economic history, he studied assets. He looked at stocks, bonds, real estate, gold. And he concluded that all of them had flaws in the digital age and were subject to the same pressures of currency debasement. Then he found Bitcoin. And what he saw wasn't a currency to buy pizza with. He saw the solution to his melting ice cube problem. He saw the world's first engineered, perfect store of value. Saylor's argument, which has now been adopted by a legion of institutional investors, is that Bitcoin is not a currency. It's property. It's digital real estate in a world where physical real estate can be taxed and seized. It's digital gold in a world where real gold is cumbersome and hard to verify. Think about the properties of gold that made it so valuable for millennia. Scarcity, durability, divisibility. Bitcoin, he argues, takes every single one of those properties and magnifies them by a factor of 1,000,000 through technology. Is it scarce? Gold is scarce, but we can always mine more. We don't even know how much is truly left in the Earth's crust. Bitcoin has a hard, unbreakable cap of 21 million coins. It is mathematically absolutely finite. There will never be more. It is the scarcest asset in human history. Is it durable? Gold is durable, but Bitcoin is pure information. It cannot rust, it cannot be destroyed. As long as the network exists, the Bitcoin exists. Is it divisible? You can divide it down to 100 millionth of a single coin. It's portable. You can move $1 billion of it across the world in minutes for a few dollars with no bank, no government permission required. Try doing that with $1 billion of gold. This is the core of the bullish thesis. It's not about buying a latte. It's about protecting your wealth, your life energy, your time, from the silent theft of inflation. Saylor's company, MicroStrategy, famously started converting its cash treasury into Bitcoin. First hundreds of millions, then billions. They weren't trading it. They were adopting it as their primary treasury reserve asset. This was a landmark moment. It was a respected, publicly traded American company, declaring to the world that it had more faith in a decentralized computer network than in the world's reserve currency. This idea is echoed by another giant in the investment world, Cathie Wood of ARK Invest. Wood's entire philosophy is built around identifying disruptive innovation. She doesn't see crypto as just one innovation. She sees it as 3 innovations happening at once. First, it's a new asset class, this digital gold that Saylor talks about. A store of value completely separate from the traditional financial system. Second, she sees it as a technology platform, a new financial internet. This is where things like Ethereum come in, with smart contracts that can automate everything from loans to insurance to stock trading, all without a bank or a broker in the middle. This is the world of decentralized finance, or DeFi, a parallel financial system being built from the ground up on the blockchain. And third, she sees it as a fundamental challenge to the way money itself is created and controlled. A monetary revolution. For the first time in history, we have a form of money that is not issued or controlled by any government or corporation. It's a network run by a consensus of its users. This is a profound shift in power, away from centralized institutions and towards the individual. ARK Invest believes this convergence of money, technology, and finance represents one of the most significant investment opportunities of our lifetime. They see the total market capitalization of crypto, which has fluctuated in the trillions, as just a tiny fraction of what it could become as it starts to absorb value from global bond markets, real estate, and gold, which are measured in the hundreds of trillions of dollars. So when you hear these experts talk about the future, they're not just looking at a chart and guessing which way the line will go next week. They are looking at the foundational principles of money and value. They are looking at the ever-increasing mountain of global debt. They are looking at the trust eroding in central banks and governments. And they see crypto, specifically Bitcoin, as a store of value and other platforms like Ethereum as a new financial infrastructure, as the logical, technological answer to a deeply flawed and aging system. They argue that the adoption of this technology isn't a matter of if, but when. And they believe we are still in the earliest days, the equivalent of discovering the internet in the mid-1990s, before a single person had ever ordered a book from Amazon or streamed a movie on Netflix. The biggest part of the story, in their view, is yet to be written. But if this is the new foundation, what kind of prices are they actually building their predictions on? What are the specific mind-boggling numbers that these experts are putting on the table for the years to come? The number that echoes through every boardroom and trading floor, the one that gets whispered in hushed, almost reverent tones, is $1 million. Not for a company, not for a block of real estate, but for a single Bitcoin. And the person championing this price target most famously is Cathie Wood, the founder and CEO of ARK Invest. This isn't just a wild guess pulled from thin air. It's the conclusion of a meticulously crafted thesis, a vision of a future where Bitcoin doesn't just participate in the financial system, it fundamentally rewires it. ARK Invest's model for $1 million Bitcoin by 2030 isn't built on a single pillar. It's a skyscraper resting on several massive foundations. The first, and perhaps the most critical one that we've seen play out in real time, is institutional adoption. For years, the crypto world was like an exclusive club with a complex secret handshake. If you wanted in, you had to navigate confusing exchanges, worry about private keys, and deal with a system that felt, to the outside world, like the Wild West. The recent approval of spot Bitcoin ETFs in the United States completely dynamited that barrier. Think about what this means. It's not just about making it easier for the average person to buy Bitcoin through their brokerage account. It's about unleashing the kraken of institutional capital. We're talking about pension funds, sovereign wealth funds, and corporate treasuries, pools of money so vast they are measured in the trillions. These entities operate under strict rules. They can't just go to a crypto exchange and start buying. They need regulated, insured, and familiar products. The ETFs, offered by the biggest names on Wall Street like BlackRock and Fidelity, are that product. They are the pristine, gold-plated, officially sanctioned bridge connecting the old world of finance with this new digital frontier. Cathie Wood's argument is that even a small allocation, just 1 or 2%, from these global institutions would create a demand shock so immense it would dwarf everything we've seen before. It's a tidal wave of capital waiting on the shore, and the floodgates have just been opened. But the institutional case is only part of the story. The second pillar is Bitcoin's evolving role as a risk-off asset. Traditionally, when economic fear spikes, when inflation runs hot or geopolitical tensions rise, investors flee to safe havens like gold or the US dollar. The expert argument is that Bitcoin is carving out a new role as the world's first digital safe haven. In a world where governments can print money at will, devaluing their currency in the process, Bitcoin stands alone with its mathematically enforced scarcity. There will only ever be 21 million Bitcoin. That code cannot be changed. This makes it, in their view, the ultimate hedge against currency debasement and inflation. While your dollars might buy you less next year, a Bitcoin will still be one of 21 millionth of the total supply forever. This isn't just a theory for wealthy investors in the West. It's a lived reality for millions in countries like Argentina or Turkey, where hyperinflation can wipe out a lifetime of savings in a matter of months. For them, Bitcoin isn't a speculation, it's a life raft. This global, grassroots adoption forms the third pillar of the bullish thesis. It's the idea of Bitcoin as a global apolitical settlement network. It allows anyone anywhere to send value to anyone else without needing a bank or a government's permission. This is a revolutionary concept. It's a financial system for the internet, and as global commerce becomes increasingly digital, the need for a native currency of the web grows stronger. Now, if Cathie Wood is the respected general laying out the strategic battle plan, Michael Saylor is the fanatical warrior king leading the charge, sword held high. The former CEO of MicroStrategy, Saylor has become one of the most vocal and influential Bitcoin proponents on the planet. He didn't just invest in Bitcoin. He converted his company's treasury into a Bitcoin acquisition machine, holding billions of dollars worth on his balance sheet. His prediction isn't just a price target, it's a philosophical conviction. Saylor sees Bitcoin not as a currency or a tech stock, but as the ultimate form of property. He calls it digital real estate. His argument is brutally simple and profound. Throughout history, humans have sought to store their wealth, their economic energy, in things that will last: land, gold, art, buildings, quality companies. But according to Saylor, all of these traditional assets have flaws. Real estate can be taxed and requires maintenance. Gold can be confiscated and is difficult to transport. Stocks are subject to corporate mismanagement and dilution. He argues that Bitcoin is the first ever engineered solution to the problem of storing value over the long term. It is, in his words, pristine collateral. It has no weight, it can't be confiscated without your keys, it can be sent around the world at the speed of light, and its supply is absolutely finite. Saylor's vision is one of a great monetary inflation, where trillions of dollars, currently sitting in bonds, real estate, and even the S&P 500, will eventually recognize their own weaknesses and start bleeding value. Where will that value flow? He believes it will inevitably flow into the one asset that cannot be debased, Bitcoin. In this scenario, $1 million Bitcoin isn't the end goal. It's just a milestone on the way to $5 or even $10 million per coin as it absorbs the monetary premium from these other, lesser asset classes. He sees a future where Bitcoin serves as the base layer of the entire global financial system, the ultimate foundation upon which everything else is built. It's an audacious, almost biblical vision of a complete financial reordering. Underpinning both of these expert outlooks is a simple, unchangeable, and powerful mechanism, hard-coded into Bitcoin itself: the halving. Approximately every 4 years, the reward that Bitcoin miners receive for securing the network is cut in half. This is the equivalent of a built-in supply shock. Imagine if, on a predictable schedule, the output of every gold mine on Earth was suddenly and permanently cut by 50%. The effect on the price of gold would be explosive. This is what happens to Bitcoin. The issuance of new supply gets progressively smaller over time, making it an increasingly scarce asset. The last halving just occurred. The next one is scheduled for 2028. Each halving event in the past has been followed by a significant bull run. The expert's argument is simple. You have a situation where institutional demand is set to explode thanks to ETFs, grassroots adoption is growing globally, and the asset is seen as a hedge against economic chaos. You combine all of that increasing demand with a programmatically guaranteed, regularly scheduled supply shock. The laws of economics suggest the price has only one direction to go. It's a perfect storm of macroeconomic tailwinds and cryptographic engineering, all pointing towards price levels that would have been unimaginable just a few years ago. But this all sounds incredibly optimistic. It sounds like a one-way ticket to unimaginable wealth with no downside. So what's the catch? What are the titanic risks and terrifying hurdles that could send this entire narrative crashing back down to earth? Are there other experts equally brilliant and equally informed who look at this exact same set of facts and come to a wildly different and far more terrifying conclusion? Yes. The answer is a deafening, resounding yes. For every wildly optimistic forecast predicting a new golden age for crypto, there is an equally compelling and frankly terrifying argument for why the entire digital asset ecosystem is built on a foundation of sand, ready to be washed away by the next major economic or regulatory tide. This isn't just FUD fear, uncertainty, and doubt, peddled by anonymous accounts on social media. This is the carefully considered consensus of some of the most powerful financial minds and regulatory bodies on the planet. And their case against the crypto bull run is chillingly persuasive. Let's start with the single biggest threat, the one that can invalidate every price chart and every technical analysis pattern overnight: the regulatory hammer. For years, the crypto industry has operated in a gray zone, a sort of digital Wild West. This ambiguity allowed for explosive innovation, but it also created a ticking time bomb. Now, governments and regulators around the world are waking up, and they are not happy with what they see. The central battle is being fought right now, in the heart of the American financial system, and it revolves around one simple question. Is a cryptocurrency a commodity, like gold or oil, or is it a security like a stock in a company? The answer to this question is not just academic, it is existential. If regulators like the Securities and Exchange Commission or SEC decide that the vast majority of cryptocurrencies are, in fact, unregistered securities, the consequences would be catastrophic. Imagine this. Almost every crypto project, every token exchange, every developer team would suddenly be subject to the same stringent, decades-old laws that govern Wall Street. They would need to register with the SEC, provide extensive financial disclosures, and adhere to a mountain of compliance rules that most are completely unprepared for. The costs would be astronomical. The innovation would grind to a halt. Exchanges would be forced to delist thousands of tokens, wiping out billions in market value instantly. It would be an extinction-level event for a huge portion of the crypto market. The SEC has already signaled its intent, launching lawsuits against major players and stating that nearly every token besides Bitcoin could be a security. This isn't a distant threat. It's a clear and present danger, a legal storm cloud gathering directly over the entire industry. But the regulatory threat isn't just domestic. Globally, institutions like the Financial Action Task Force are pushing for coordinated rules to combat money laundering and terrorist financing through crypto. While these goals are noble, the proposed travel rule, for example, threatens to dismantle the very privacy and decentralization that many see as crypto's core value proposition. A coordinated global crackdown, where the world's major economies move in lockstep to heavily restrict or control digital assets, is no longer a fringe conspiracy theory. It's a scenario being actively discussed in the halls of power, from Washington to Brussels to Beijing. Even if crypto survives this regulatory onslaught, it faces a second, perhaps even more formidable opponent: the global macroeconomic environment. The bull run of 2021 didn't happen in a vacuum. It was fueled by an unprecedented wave of easy money. Governments were printing trillions of dollars in stimulus, and central banks had interest rates at zero. Money was cheap and people were flush with cash looking for a place to put it. Speculative assets like crypto were the perfect destination. That world is gone. We now live in an era of high inflation and the most aggressive interest rate hikes in modern history. The Federal Reserve and other central banks are on a mission to stamp out inflation, and their primary weapon is making money expensive again. Why does this matter? Because when you can get a safe, guaranteed 5% return from a government bond, the appeal of a volatile, risky asset like crypto diminishes significantly. The free money firehose that once sprayed rocket fuel on the crypto markets has been turned off, replaced by a trickle of cautious, risk-averse capital. This leads to the dreaded R word, recession. The entire point of raising interest rates is to slow down the economy, but it's a blunt instrument. If central banks go too far, they risk tipping the economy into a full-blown recession. And history tells us one thing with absolute certainty. When a recession hits and people start losing their jobs, speculative assets are the first things to be sold. When you're worried about paying your mortgage or putting food on the table, your portfolio of altcoins is no longer an exciting investment. It's a source of emergency cash. The institutional money that bulls are counting on? In a recession, they too flee from risk, seeking the safety of cash and government debt. This isn't a crypto-specific problem. It's a fundamental law of financial gravity. And right now, that gravity is pulling everything downward with immense force. Finally, we have to confront the oldest, most profound, and most persistent criticism of all, the one that skeptics like Warren Buffett and Charlie Munger have been leveling for years. This is the argument that keeps crypto veterans awake at night because on a certain level, it is undeniably true. The argument is this: crypto has no intrinsic value. Think about it. When you buy a share of Apple stock, you are buying a tiny piece of a real company that makes real products, employs real people, and generates billions of dollars in real profit. Produces cash flow. When you buy a piece of real estate, you own a physical asset that can be rented out to generate income. Even a commodity like gold has thousands of years of history as a store of value and has industrial and decorative uses. But what does a cryptocurrency produce? Nothing. It doesn't generate revenue. It doesn't pay a dividend. It doesn't have a physical form. Its value, the bearish argument goes, is derived entirely from one thing: the belief that someone else, a greater fool, will be willing to pay more for it in the future. It's a theory based purely on speculation and collective belief. If that belief wavers, if the narrative breaks, there is no underlying value to stop the price from falling. There is no PE ratio, no balance sheet, no cash flow statement to analyze. There is only sentiment. And as we've seen time and time again, sentiment can turn on a dime, causing prices to collapse 80 or 90% with terrifying speed. So when you combine these three forces, the picture becomes incredibly bleak. You have a regulatory superstorm on the horizon, threatening to legislate huge parts of the industry out of existence. You have a brutal macroeconomic environment that is actively hostile to risky, speculative assets. And you have an underlying philosophical critique that the entire asset class is a house of cards, built on nothing more than collective belief. This is the perfect storm. This is the bearish thesis. And it's why some of the smartest experts in the world are not predicting a new all-time high, but a crypto winter, so long and so cold that it could freeze the industry solid for years to come, if not forever. Let's start with the most famous of the crypto bears, economist Nouriel Roubini, the man they call Dr. Doom, for correctly predicting the 2008 financial crisis. To him, crypto isn't just in a winter, it's in a terminal decline. He argues that the entire ecosystem is, in his words, a completely corrupt, criminal, rotten cesspool. He points to the staggering lack of any real-world utility. After more than a decade, what can you actually buy with Bitcoin on a daily basis? A cup of coffee? A new car? The answer for the vast majority of people is still nothing. The transaction speeds are slow, the fees can be high, and the price is so volatile that no sane merchant would accept it without immediately converting it back to dollars. Roubini's thesis is that crypto has failed its most basic test: to be a functional currency. It's not a unit of account, it's not a scalable means of payment, and it's a disastrous store of value. He sees it as a solution in search of a problem, a technology whose only real use case has been speculation and facilitating illicit activity. And it's this speculative nature that makes it so vulnerable to the single biggest threat facing it today: the macroeconomic environment. The 2021 bull run didn't happen in a vacuum. It was fueled by the largest monetary experiment in human history. Governments around the world, particularly in the United States, printed trillions of dollars and injected them into the economy to fight the pandemic-induced slowdown. Interest rates were slashed to zero. People were sitting at home, flush with stimulus checks, with nothing to spend it on. That tidal wave of cheap, easy money had to go somewhere, and it flowed directly into the riskiest assets imaginable: meme stocks, NFTs, and of course crypto. It was a party where the drinks were free and the music never stopped. But now that party is over. The Federal Reserve has slammed on the brakes harder than at any point in the last 40 years. To combat runaway inflation, an inflation that was partly caused by all that money printing, they have embarked on the most aggressive interest rate hiking cycle in modern history. And for an asset class like crypto, which produces no yield, No dividends and no cash flow. Higher interest rates are pure kryptonite. Think about it from an investor's perspective. A few years ago, leaving your money in a savings account was a losing game. You were earning maybe 0.1% while inflation was eating away at your purchasing power. So, you were almost forced to take risks to get any kind of return. A gamble on Dogecoin seemed more attractive. Today, the situation is completely reversed. You can now buy a United States Treasury bond, an asset considered the safest on planet Earth, backed by the full faith and credit of the US government, and get a risk-free return of 4 or 5%. So the question every major investor is asking is, why would I risk my capital on an incredibly volatile, unregulated asset like Bitcoin, which could drop 50% overnight, when I can get a guaranteed 5% return from the US government? The answer for many is that you wouldn't. This is what Wall Street calls capital rotation. Money is flowing out of high-risk assets and into safe havens. The tide of free money has gone out, and as the saying goes, we're now seeing who was swimming naked. The bearish argument is that the entire crypto ecosystem was built on that tide of free money, and without it, the whole thing will be left stranded on the beach. This is compounded by the Fed's other weapon, quantitative tightening or QT. It's the opposite of money printing. Instead of injecting liquidity into the system, the Fed is now actively pulling it out, shrinking its balance sheet by billions of dollars every month. Less money in the system means less fuel for speculative fires. Every dollar becomes more valuable, and investors become more discerning about where they put it. The era of number go up, just because there's too much money sloshing around is, according to the bears, definitively over. But the macroeconomic storm is only one half of the equation. The other, perhaps even more dangerous threat, is coming from Washington, D.C. The regulatory hammer is finally coming down. For years, the crypto industry operated in a gray area, a sort of Wild West where innovation could flourish without government oversight. That era has come to a violent end. The Securities and Exchange Commission, the SEC, led by its chairman Gary Gensler, has declared what many in the industry call an all-out war on crypto. Gensler's position is simple. He believes that virtually every single cryptocurrency, with the possible exception of Bitcoin, is an unregistered security. And if they are securities, they must comply with the same strict disclosure and registration rules that companies like Apple or Tesla have to follow when they sell stock to the public. This is not a minor technicality, it's an existential threat. The SEC has launched a legal blitzkrieg, suing some of the biggest names in the industry, including Coinbase, the largest US exchange, and Binance, the largest exchange in the world. The lawsuits allege that these platforms have been illegally facilitating the trade of unregistered securities for years. If the SEC wins these cases, it could force dozens, if not hundreds, of popular altcoins to be delisted from US exchanges, effectively wiping out their primary source of liquidity and making them inaccessible to American investors. This regulatory uncertainty hangs like a guillotine over the entire market. How can a major pension fund or a Fortune 500 company invest billions of dollars into this asset class when the chief financial regulator is actively trying to sue it out of existence? This isn't just about lawsuits either. There's a broader, more insidious strategy at play, which critics have dubbed Operation Choke Point 2.0. The theory is that federal regulators are pressuring banks to cut ties with crypto firms. We saw this in action with the collapse of crypto-friendly banks like Silvergate and Signature. Without reliable access to the traditional banking system, it becomes incredibly difficult for crypto companies to operate, to process customer deposits and withdrawals, to pay their employees, to function as a legitimate business. It's an attempt, the bears argue, to cut the industry off at the knees by denying it the financial oxygen it needs to breathe. This two-pronged attack, a hostile macroeconomic environment, and an aggressive regulatory crackdown, creates a feedback loop of fear. The scandals of the last cycle have only poured gasoline on this fire. The catastrophic collapse of FTX, a company once seen as the golden child of the industry, revealed a level of fraud and mismanagement that shocked even the most cynical observers. Billions of dollars in customer funds simply vanished. Then there was the implosion of Celsius, Voyager, and the Terra/Luna ecosystem, which wiped out another $60 billion of value in a matter of days. These events weren't just financial losses. They were a catastrophic blow to the narrative. They shattered the trust of an entire generation of retail investors who were told that this was the future of finance, only to see their life savings evaporate. The bears argue that the damage is irreparable. The greater fool theory, the idea that you can always find someone else a greater fool, To buy your asset at a higher price only works when there's a steady stream of new, optimistic buyers entering the market. But after seeing Sam Bankman-Fried in handcuffs and hearing stories of financial ruin, where will that new wave of buyers come from? The bearish thesis is that they won't. The combination of a tight money environment, a hostile government, and a shattered public trust has created a perfect storm. They believe crypto is now trapped. It can't go back to the unregulated Wild West of the past, but it can't seem to find a path to legitimate integration with the traditional financial system either. It is stuck in a regulatory and economic no man's land, with no clear catalyst for growth and a mountain of headwinds pushing it down. The argument isn't just that prices will go lower. It's that the fundamental premise for a new bull run has been completely dismantled. But this entire bearish argument hinges on one massive, and potentially flawed, assumption that the next crypto bull run will look anything like the last one. The experts who are quietly positioning for the next major upswing aren't looking at the retail-driven, meme-fueled frenzy of 2021 as a model. They're looking at it as the chaotic adolescent phase that the market had to endure before it could finally grow up. In their view, the fundamental premise for a bull run hasn't been dismantled. It's been completely rebuilt, on a foundation of solid granite instead of sand. The new premise is not about hype or stimulus checks or a get-rich-quick mentality. It's about something far more powerful, far more permanent, and orders of magnitude larger. The systematic, methodical, and relentless entry of institutional capital. What we're witnessing, according to this school of thought, is a changing of the guard. The era of the retail investor as the primary market mover is ending. We are now entering the era of the institution. Think about it. For years, the holy grail for crypto was a spot Bitcoin ETF. It was talked about in hushed, almost mythical tones. The Winklevoss twins tried and failed. Grayscale tried and was denied. It seemed like a regulatory fantasy, a bridge too far for the traditional financial world. And then it happened. Not with a whimper but with a bang. BlackRock, the world's largest asset manager with over $10 trillion under its control, filed for a spot Bitcoin ETF. And they weren't alone. Fidelity, Invesco, Franklin Templeton, the absolute titans of Wall Street, all piled in. This wasn't just a signal. It was a seismic shift in the entire landscape. To understand the magnitude of this, you have to understand what an ETF actually does. For the average person, buying Bitcoin before was a process filled with friction. You had to sign up for a specific crypto exchange, deal with Know Your Customer laws, figure out how to transfer money, and then grapple with the terrifying prospect of self-custody. Private keys, seed phrases, hardware wallets. It was a technical and psychological barrier that kept millions of potential investors, and more importantly, their financial advisors on the sidelines. A financial advisor couldn't just tell their 65-year-old client to open a Coinbase account and buy a ledger. The compliance and liability risks were astronomical. The spot Bitcoin ETF vaporizes all of that friction. It wraps Bitcoin in a familiar, trusted, and highly regulated package. Now that same financial advisor can allocate a small percentage of their client's portfolio to Bitcoin with a single click, right alongside their stocks and bonds, inside the same retirement account they've had for 30 years. The ETF ticker symbol, IBIT for BlackRock, FBTC for Fidelity, sits right next to Apple and Microsoft. It transforms Bitcoin from a fringe, speculative digital oddity into a legitimate, investable asset class for the most conservative, risk-averse capital pools in the world. We're talking about pension funds, endowments, sovereign wealth funds, and the trillions of dollars managed by registered investment advisors. The initial inflows into these ETFs were historic, the most successful ETF launch of all time. But the experts who are bullish believe this is just the first drop in an ocean of capital. The initial wave was from the early adopters within the traditional finance world. The next wave will come as these products get approved on major wealth management platforms like Merrill Lynch and Morgan Stanley, making them available to an even wider base of clients. The argument is that we are in the first inning of a multi-year process of institutional adoption. Every major bank is now building out a digital assets division. They're not doing it because they've suddenly become crypto idealists. They're doing it because their biggest clients are demanding access. This leads to a completely different price dynamic than what we've seen before. The retail-driven rallies were characterized by explosive, parabolic spikes followed by devastating 80 to 90% crashes. They were fueled by FOMO, the fear of missing out. The institutional rally, these experts argue, will be a slow burn. It will be driven by systematic allocation. A pension fund doesn't ape in. It decides to allocate, say, 1% of its portfolio to Bitcoin. It then spends the next 12 to 24 months slowly buying that position to avoid moving the market. Now imagine thousands of these funds all doing the same thing all at the same time. It creates a constant underlying bid pressure, a persistent steady flow of demand that is completely insensitive to short-term price swings, Twitter sentiment, or the latest meme coin. This is dumb money in the best possible sense of the word. Capital that is allocated based on a long-term thesis and isn't trying to time the top or bottom. This, they argue, creates a much higher price floor and leads to a less volatile, grinding melt-up in price over several years, rather than a frantic spike over several months. And this institutional embrace goes far beyond just Bitcoin. The infrastructure being built by BlackRock, Fidelity, and others isn't just for one asset. It's for the entire digital asset ecosystem. The next major narrative that has these experts incredibly excited is the tokenization of real-world assets, or RWAs. This is the concept of taking traditional assets, like real estate, private equity, fine art, or government bonds, and representing them as a digital token on a blockchain. Why would you do this? The benefits are staggering. It allows for fractional ownership, meaning you could buy a $100 piece of a Manhattan skyscraper. It enables 24/7 global trading, breaking down geographic and time zone barriers. It dramatically reduces settlement times and administrative costs by using smart contracts to automate processes that currently require teams of lawyers and bankers. Larry Fink, the CEO of BlackRock, has been extremely vocal about this. He hasn't just said he's bullish on Bitcoin. He has stated that the tokenization of every financial asset is the next step in the evolution of markets. This isn't some crypto influencer on YouTube saying this. It's the most powerful man in finance. When he says that, every other financial institution on the planet listens. They are now all in a race to figure out how to tokenize assets and what blockchain technology they will use to do it. This creates immense potential value for the underlying infrastructure of crypto, the smart contract platforms like Ethereum and its competitors. The thesis is that if trillions of dollars of real-world assets eventually move on-chain, the networks that secure and process those transactions will have to be worth a commensurate amount. So, from this perspective, the bear case is completely missing the forest for the trees. It's focused on the dying embers of the last cycle retail sentiment, high interest rates, and regulatory crackdowns on the old Wild West crypto companies. The bulls, meanwhile, are looking at the new financial rails being laid by the largest institutions on Earth. They see the ETFs not as a top signal, but as the opening of the floodgates. They see the RWA narrative not as a distant dream, but as the explicit, publicly stated roadmap of firms that control the flow of global capital. The argument is that the crypto market is being fundamentally repriced, not based on the whims of individual traders, but on its integration into the very core of the global financial system. The question is no longer if institutional money is coming to crypto. The question is what happens when a meaningful fraction of the hundreds of trillions of dollars in global managed assets decides it needs even a 1% allocation. Let's actually do the math on that because the numbers are so staggering they almost sound fake. The total value of professionally managed assets globally is estimated to be over $100 trillion. Some estimates push it closer to 150 trillion. Let's be conservative and just call it an even 100 trillion. A 1% allocation of that is $1 trillion. $1 trillion. For perspective, the entire market capitalization of Bitcoin at its all-time high was around 1.3 trillion. So a mere 1% shift in global asset allocation would be like injecting an entire 2021 bull market peak's worth of capital directly into Bitcoin alone. And that's just Bitcoin. We haven't even touched Ethereum or the rest of the ecosystem. Now imagine what a 2% allocation looks like, or a 5% allocation, which is what many forward-thinking wealth advisors are now recommending for a diversified portfolio. The numbers become astronomical. We're talking about a potential capital inflow that would dwarf everything we've seen in crypto's entire history combined. This isn't just a small wave. It's a potential tsunami of capital, and the first tremors are already being felt. The BlackRock Bitcoin ETF wasn't just another product launch. It was a signal flare. It was the world's largest asset manager, with over $10 trillion under its watch, giving a formal, regulated, and incredibly loud stamp of approval. And they weren't alone. Fidelity, Invesco, Franklin Templeton, these are not scrappy tech startups. These are the pillars of the traditional financial world. They have spent decades building trust with the world's wealthiest individuals, pension funds, and sovereign wealth funds. When they offer a product, their clients listen. The conversation inside these institutions has fundamentally shifted. For years, the biggest risk for a fund manager was buying Bitcoin. If you bought it and it went down, you could lose your job. It was seen as a reckless, speculative gamble. Today, that logic is beginning to flip on its head. The new career risk is not having an allocation to crypto. Imagine being a pension fund manager in 2030, trying to explain to your board why you missed out on the best performing asset class of the decade. Imagine trying to justify why your fund's returns are lagging behind everyone else's because you wrote off digital assets as a fad. That's the new fear. It's the fear of being left behind. It's the same fear that drove institutions to pile into internet stocks in the late 90s. Even when they didn't fully understand them, they just knew they had to be there. This shift is driven by a concept called the Lindy effect, which suggests that the longer a non-perishable thing like a technology or an idea survives, the longer it's likely to persist in the future. Bitcoin has now been around for over 15 years. It has survived multiple crashes of over 80%. It has been declared dead by the media over 400 times. Yet it's still here. It's more secure, more decentralized, and more valuable than ever. For an institution that thinks in terms of decades, not days, that kind of resilience is incredibly attractive. It proves that Bitcoin isn't a fleeting fad. It's a permanent feature of the new financial landscape. But let's be realistic. This flood of institutional money isn't going to happen overnight. There are still major hurdles, and the biggest one by far is regulatory clarity in the United States. The ongoing battle between crypto companies and agencies like the SEC creates a fog of uncertainty that large, conservative institutions hate. They need clear rules of the road before they can deploy billions of dollars. They need to know definitively whether assets like Ethereum are considered commodities or securities. They need a stable framework for custody, for trading, and for reporting. This regulatory drag is the single biggest brake on institutional adoption right now. However, most experts see this as a temporary problem. The pressure from both the public and major financial players is becoming immense. Eventually, Congress will be forced to act and create a clear, comprehensive legal framework. And when that day comes, the floodgates will truly open. The second major hurdle that had to be overcome was custody. You can't just store $1 billion worth of Bitcoin on a USB stick in a desk drawer. Institutions need what's called qualified custodians, highly secure, regulated, and insured entities that can safeguard these assets. For years, these simply didn't exist. But now they do. Giants of the financial world, like BNY Mellon, America's oldest bank, and State Street, are now offering crypto custody services. Coinbase has built an entire division, Coinbase Prime, specifically to cater to these massive clients. Fidelity has Fidelity Digital Assets. The infrastructure is being built piece by piece right before our eyes. The pipes are being laid to connect the vast ocean of traditional finance to the burgeoning world of crypto. And finally, there's the issue of volatility. How does a pension fund, which has a duty to preserve capital, justify investing in an asset that can drop 20% in a single day? The answer is that they approach it completely differently than a retail investor. They don't care about the daily price swings. They are allocating a tiny fraction of their overall portfolio, say 1%, with a time horizon of 10 to 20 years. They understand that on that timescale, the day-to-day volatility becomes noise. The long-term trend is what matters. Furthermore, they have access to sophisticated financial instruments to manage this risk. They can use options and futures contracts to hedge their positions, something the average person can't easily do. So while the volatility might scare away the faint of heart, for a sophisticated institution, it's simply a variable to be managed, not a barrier to entry. This institutional adoption is perhaps the single most important narrative for the future of crypto prices, because it introduces a completely new type of market participant. The crypto markets of the past were almost entirely driven by retail investors and a handful of crypto-native funds. This meant they were highly emotional, prone to massive hype cycles and devastating crashes. The institutional buyer is different. They are not emotional. They are not chasing 100x gains on a meme coin. They are methodical, data-driven, and most importantly, they have deep pockets. They buy based on long-term theses and portfolio allocation models. They will buy during downturns, a practice known as buying the dip, with far more capital than retail ever could. This creates a buy wall, a level of persistent underlying demand that could fundamentally change the market structure. It could lead to less severe bear markets and more sustained, steady growth over the long term. What we are witnessing is the slow, deliberate, and unstoppable professionalization of the crypto asset class. It's moving from the fringes of the internet to the center of Wall Street's balance sheets. Every single expert, from the most bullish crypto evangelist to the most skeptical banker, agrees on this one point. The institutions are here and more are coming. The only thing they disagree on is the speed at which it will happen. But the direction of travel is no longer in doubt. But this institutional story, as massive as it is, doesn't happen in a vacuum. It's happening against the backdrop of one of the most chaotic and uncertain macroeconomic environments in modern history. And how central banks, inflation, and global debt play into this? Well, that changes the entire equation. Let's break down that equation. For the past decade, and especially since 2020, the entire financial world has been running on a single fuel source: cheap money. Central banks, led by the US Federal Reserve, responded to the pandemic by injecting trillions upon trillions of newly created dollars into the system. It was the largest monetary expansion in human history. This cash had to go somewhere. It flooded into stocks, real estate, and of course crypto. It was the ultimate risk-on environment. A party where the drinks were free and everyone was getting rich. Bitcoin soaring from under $10,000 to nearly $70,000 wasn't just a story about technology. It was a story about liquidity. But every party has a hangover. The consequence of all that money printing was inflation, the kind we haven't seen in 40 years. The price of everything from gasoline to groceries exploded, and the Fed had to act. They slammed on the brakes, hiking interest rates at the fastest pace in modern history. This was a monetary earthquake. The entire logic of the market flipped overnight. Suddenly, you could earn a safe, guaranteed 5% return just by holding US government bonds. Why would you gamble on a volatile asset like crypto when you could get paid to do nothing? This single action, the raising of interest rates, was the pin that popped the 2021 crypto bubble. The free money spigot was turned off, and the tide went out, revealing who was swimming naked. Companies built on a foundation of leverage and cheap debt like Celsius, Voyager, and ultimately FTX were wiped out. The crash of 2022 wasn't random. It was a direct, predictable consequence of the shift in the macroeconomic environment. The correlation is undeniable. When the Fed prints money and cuts rates, crypto soars. When the Fed tightens its belt and raises rates, crypto bleeds. It's that simple. So, for the past 2 years, the crypto market has been playing a game of chicken with the Federal Reserve. Every investor, every analyst has been obsessed with one question: when will the Fed pivot? When will they start cutting rates again and turn the money spigot back on? The market has desperately searched for any sign of weakness in the economy, any hint of rising unemployment, any dip in inflation that would give the Fed an excuse to cut. We saw it in late 2023. The market got a whiff of potential rate cuts in 2024, and Bitcoin instantly rallied from the high 20s to over $40,000. That wasn't the ETF approval. That was the macro tailwind. But inflation has proven to be a stubborn beast. It hasn't gone away as quickly as the experts hoped. The economy has remained surprisingly resilient. And so the Fed has been forced to stick to its mantra: higher for longer. This is the great wall that crypto prices have been slamming into. The halving can cut supply, the ETFs can bring in new demand, but as long as the cost of money is high, there is a natural ceiling on how far risk assets can run. Big institutional players aren't going to pour hundreds of billions into Bitcoin when they can get a risk-free return elsewhere that looks just as good. This is the headwind. This is the fight. But this is where the story gets really interesting, and where the most forward-thinking experts see not just a headwind, but the signs of a coming hurricane that changes everything. They argue that the Federal Reserve is trapped. They are caught between a rock and a hard place, and one of them is the US government's staggering, incomprehensible level of debt. Right now, the United States national debt is over $34 trillion. It's a number so large it's almost meaningless. But what isn't meaningless is the interest the government has to pay on that debt. Every year, the US Treasury has to pay interest to its bondholders. When interest rates were near zero, this was manageable. But now, with rates at 5%, the annual interest payment on the national debt has exploded. It has surpassed $1 trillion a year. Let that sink in. The US government is now spending more on interest payments than it does on its entire national defense budget, spending more on interest than it does on Medicare. This is not sustainable. It's a mathematical certainty. This creates what analysts call a debt spiral. To pay the trillion-dollar interest bill, the Treasury has to issue even more new debt. But issuing more debt increases the total debt pile. which in turn increases the next year's interest payment, forcing them to issue even more debt just to stay afloat. It's a feedback loop from hell. And this is the Fed's trap. On one hand, they need to keep interest rates high to fight inflation and maintain the credibility of the US dollar as the world's reserve currency. If they cut rates too early, inflation could come roaring back, and faith in the dollar could be shattered. On the other hand, by keeping rates high, they are actively accelerating the US government's path toward a fiscal crisis. They are tightening the noose. So what happens? What breaks first? According to macro experts like Lynn Alden and Arthur Hayes, there is only one way out of this trap. It's the same way out governments have taken throughout all of human history when faced with an insurmountable debt load. They can't default on the debt outright, that would be catastrophic. They can't raise taxes enough to cover the shortfall. That would be political suicide and would crash the economy. So they choose the third option, they print the money. At some point in the not-too-distant future, the Federal Reserve will be forced to pivot. They will be forced to cut interest rates and turn the money printers back on, not because they've won the fight against inflation but because they have to. They will have to monetize the government's debt to prevent a full-blown crisis in the US Treasury market, which is the bedrock of the entire global financial system. They will have to sacrifice the value of the dollar to save the system itself. This is the real bull case for Bitcoin. It's not about getting rich quick. It's not about meme coins or NFTs. It's about a profound once-in-a-generation shift in the macroeconomic landscape, when the world's dominant currency is being deliberately and systematically devalued to manage an unpayable debt burden. Where do you store your wealth? Where do you put your life savings to protect it from being inflated away? You don't put it in a savings account that yields less than the real rate of inflation. You don't put it in bonds that are being propped up by printed money. You seek out assets that are scarce, that are sovereign, and that cannot be created out of thin air by a central authority. For millennia, that asset was gold. But in the 21st century, a new digital alternative has emerged. An asset with a mathematically guaranteed, absolutely fixed supply of 21 million units, secured by the most powerful computer network in the world. The experts who understand this macroeconomic picture see the current price action as mere noise before the storm. They see the ETFs and the halving as the kindling, but they see the coming monetary debasement as the gasoline. They believe we are on the cusp of a moment where people stop seeing Bitcoin as a speculative gamble and start seeing it as a necessary insurance policy, an escape hatch from a monetary system that is cracking under the weight of its own promises. This isn't just about a price prediction. It's a prediction about a fundamental change in the very definition of money itself. And if they're even partially right, the numbers being thrown around for Bitcoin's future price might not be so crazy after all. In fact, they might be conservative. So let's take that idea seriously for a moment. What if a $1 million price target for a single Bitcoin isn't the ceiling but the ground floor? This is where the conversation shifts from mere financial analysis into the realm of technological and social revolution. The most forward-thinking experts aren't just looking at charts. They're looking at history. They see the transition from shells to salt, from precious metals to paper notes backed by governments, and now they see the next logical step: the transition to a global, decentralized, digital store of value. This is the theory known as hyper-Bitcoinization. It's a term that sounds like something out of a science fiction novel, but the concept is surprisingly simple. It describes a future state where Bitcoin has become the world's dominant store of value, displacing assets like gold, real estate, and even government bonds. In this scenario, people and institutions around the globe voluntarily choose to save their wealth in Bitcoin because they lose faith in their own national currencies to hold value over time. Think about it. We're already seeing the early stages of this in countries with hyperinflation like Argentina or Turkey, where citizens are flocking to Bitcoin and stablecoins not to get rich quick, but simply to preserve the value of their labor from being evaporated by their own governments. Hyper-Bitcoinization theory suggests that this isn't an isolated phenomenon for developing nations. It's a preview of what could happen everywhere as debt levels rise and central banks are forced to print more and more money to keep the system afloat. In a hyper-Bitcoinized world, the price of Bitcoin in US dollars would become an irrelevant metric. It would be like asking how many dollars a dollar is worth. Instead, goods and services would be priced in satoshis, the smallest unit of a Bitcoin. Your house wouldn't be worth $1 million, it might be worth 1,000 satoshis. The mental shift is enormous. It flips the entire financial world on its head. Instead of an inflationary currency where your money buys less tomorrow, you'd have a deflationary asset where your savings naturally buy more over time. This incentivizes saving and long-term thinking over consumption and debt. Now, this sounds like a utopia to some and a dystopia to others, and the path to such a future would be anything but smooth. This is where the ultimate battle lies. The biggest risk to crypto isn't a market crash or a new competitor. It's the existing system fighting for its life. Governments derive immense power from their control over the money supply. The ability to print currency, fund deficits, and wield economic influence. A decentralized global currency that they cannot control, cannot seize, and cannot inflate away is a direct existential threat to that power. So, what are the final bosses crypto has to defeat on its way to these astronomical price targets? First, coordinated global regulation. We're not talking about sensible investor protections. We're talking about hostile, restrictive measures designed to cripple the industry. Think outright bans, prohibitive taxes on crypto to fiat conversions, or even a tax on the network infrastructure itself. While a truly decentralized network like Bitcoin is incredibly resilient, a coordinated global attack could severely hinder its adoption and price for years. Second, there's the Black Swan technological event. While the Bitcoin network has run without interruption for over a decade, a catastrophic bug or a breakthrough in quantum computing that could theoretically break its encryption is a non-zero risk. The brightest minds in the space work on these problems constantly, but it remains the unknown unknown that keeps even the most bullish experts up at night. And third, there is the risk of societal rejection. For this technology to reach its full potential, it needs more than just institutional adoption. It needs a critical mass of individuals to understand it, trust it, and use it. If the narrative gets permanently hijacked by scams, energy consumption debates, and volatility, and the public decides it's just a dangerous digital casino, then its growth could stall out long before it ever challenges the global financial order. So, given these colossal risks, why are so many brilliant people still betting on its success? It comes down to a concept from the world of venture capital: asymmetric bets. An asymmetric bet is one where the potential upside is exponentially greater than the potential downside. Your downside is capped. If you invest a small portion of your portfolio into crypto, say 1 or 2%, the most you can lose is that 1 or 2%. It's a painful loss, but for most, it's not a life-altering one. The potential upside, however, is uncapped. If the experts who see Bitcoin as the new global reserve asset are even a fraction correct, that 1 or 2% of your portfolio could grow to become 10, 20, or even 50% of your total net worth. It has the potential to be one of the single greatest wealth transfers in human history. We are living in an era where traditional assets like stocks and real estate have become so expensive that it feels impossible for the average person, especially the younger generation, to get ahead. The ladder to prosperity feels like it's been pulled up. Crypto, for many, represents a new ladder. It's a chance to front-run the institutions, to own a piece of a new technological paradigm before it's fully integrated and priced in by Wall Street. This is the core of the expert argument that often gets lost in the noise of daily price charts. They see an asset that is simultaneously a technology, a commodity, and a monetary network. They see the unstoppable force of digitization, meeting the immovable object of sound money principles. They see the game theory that incentivizes more and more people to join the network, making it stronger with each new user. Ultimately, the future of crypto prices is like Schrodinger's cat. It exists in a state of superposition. Inside the box, it is simultaneously going to zero and going to millions of dollars. It is both a worthless Ponzi scheme and the foundation of a new global financial system. Both outcomes are possible. The experts we've listened to are not fortune tellers. They are simply observers, analyzing the forces inside and outside that box, and making an educated guess as to which outcome is more probable when the box is finally opened. What they are all saying, from the Wall Street analyst to the Silicon Valley visionary, is that the probability of it being worthless is shrinking every single day. Every time a new ETF is approved, every time a Fortune 500 company adds Bitcoin to its balance sheet, every time a new developer writes a line of code for the network, the probability of success ticks slightly higher. They are saying that ignoring this asset class is no longer a conservative strategy. It's a risky one. It's a bet that the current system of ever-increasing debt and endless money printing can continue forever without consequences. And that is a bet that, throughout history, has never paid off. So the ultimate takeaway isn't a specific price target or a date on a calendar. It's an understanding of the profound shift that is happening underneath the surface. The experts aren't just predicting the future of an asset, they are predicting the future of money itself. They're telling us that the very foundation of our economic world is changing. And a technology has emerged that offers a completely different path forward. A path of verifiable scarcity, of decentralized control, and of individual sovereignty. The price is just a reflection of the world slowly waking up to that possibility. The only question left is, how long will it take for everyone else to see it too?